Hello everybody, Tom Crumpton with another video. This one's called Why Your Deal Died in Due Diligence and You Didn't See It Coming. Spoiler alert, probably your fault. You can prevent it by running a seller side underwriting initially. Do the work. Go through the building, go through the roof, go through the delayed maintenance, stress test the NOI, reconcile the leases and the rent roll. Just because he says I'm making $8,000 a month from this guy, get the lease. Get the actual numbers. Get a lender level underwriting done before going to market. Most lenders, if you've got a relationship with them, if you do the work ahead of time, put all the numbers in, send it to them, they'll tell you if it works. They'll tell you if it doesn't. They'll tell you what you got to do to make it right. Be honest about the risk. Price it accordingly. Just because you pull up a CoStar report or Ready report and it says market rates are this, dig a little deeper. Find out what those market rates really were. The numbers were pro forma strong, but not really good, not really strong. You wrote a pro forma on what the rent could be, or what the seller told you to rent, or he told you what the rent increases were going to be. You took his word for value. You put that in the presentation, and then when it came in, the numbers weren't right. What the buyer sees, it doesn't perform like it was marketed. Number two reason, the debt falls apart midstream. Even the buyer loves the deal, and he may still be willing to pay for a glitch or two. The lender may not. Common landmines, the appraisal comes in light. Way to fix that is give all the appraisal information you can to the appraiser ahead of time. Debt service cover ratio below where it needs to be. Run the numbers ahead of time. Check on insurance costs. Are they going up? Right now insurance is X, and next year it's going to be X plus 25 or 40%. That's going to affect what's left. That's going to affect the debt service coverage ratio. It's going to affect everything. Term sheets aren't loan approvals. You have to keep working. Just because the lender says, hey, you can do this, or we'll do this, doesn't mean it can get done. Number three reason is physical issues you knew about, but didn't price. The roof seller told you it had a few more years. You didn't pull to see when it was replaced last. You didn't pull to see if there was anything in the insurance policy talking about it. How old was it? What's the new lender's rules on roof age? Make sure there aren't any new ADA requirements or regulations since the last time that it sold. Deferred maintenance is a silent valuation haircut or a deal killer. Number four was the tenant risk was concentrated. If you've got 8 bays, but Bill rents 7 of them, you have one tenant. You need to examine those. You need to examine the strength of each tenant. The other one's environmental and legal issues. Man, if there used to be a gas station next door that closed down 3 years ago, get your phase one. If it's bad, it's bad, and you're not going forward. And he's going to have to get the phase one anyway. So be honest with the seller and tell him we need to do these things. One that's more rare and not so much the selling broker's fault. Every now and then, PE world, family environment, family retail world, the buyer's investment committee will kill it. And too often what happens is somebody will come in from one of these organizations, will put down an LOI and say, hey, we want to buy this. And one of the contingencies, about page 42 in small letters, is their investment committee has to approve it. Don't let that drag out 60, 90 days. Don't do a whole lot of work until somebody comes in to bless it, because otherwise you could do all kinds of stuff. Redo the parking lot, fix the roof, redo the air conditioning, and they come in and go, no, it's on the wrong side of the road. It's on the wrong side of town. They don't need a specific reason. They just have to have that clause in there that says they can kill it. So get past that. Don't let that go too long, because if you do, you're going to be retrading or walking away. Why you didn't see it coming? You believe the LOI was a commitment. It wasn't. It was just a discussion in writing. Look at those LOIs. They all say non-binding. You assume the buyer's capital was secure. That's another one. You relied on marketing numbers instead of underwriting numbers. You didn't run a pre-sale audit on the diligence. Don't wait for the appraisal. Don't wait for the bank to come back. Take things to them. Be proactive. Deals don't die because the seller did something wrong usually, or the buyer did something wrong usually. Most of the time it's our fault. Tom Crumpton, CCIM, commercial experts, trying to help you not make mistakes a lot of us have made.